Right, so let's look at the second part, which is the dividends and the shareholders. Now again, the shareholders are the people. You see, the name tells you. These are the shareholders, the actual owners of the company that you owe dividends to. So this becomes your liability account. On the other hand, you pay them dividends. And that dividends, your ordinary share dividends, that is your expense account. So that's what you have to pay. And if you owe them, you bring a liability in. So now let's have a look. In the exercise here, we've got 50,000 shares issued at the beginning of the year. And we were told that we had an authorized of 75,000. That's what they're allowed to sell. So the first thing now, they said to the directors, issued the remaining ordinary shares. So that's the extra 25,000. So all 75,000 have now been issued. Now that will go into the share capital account, and I'm not really focusing on that at the moment. But for the purpose of what I'm looking at, this next line is important. These shares, these extra shares, the extra 25,000, do not qualify for an interim dividend. Now dividends is a share of the profits. Once the business has made the profits and has paid its tax, that money belongs to the shareholders. And they can pay out that amount to the shareholders. Now, generally, it can be paid out in 2 stages during the course of the year, which we call an interim, and then a final dividend, which is at the end of the year. This interim dividend, the directors will decide to pay this out if they see they're making good profits, they want to keep their shareholders happy, they might decide to pay out a dividend. So if we look here, the directors declared and paid, very important, an interim dividend of 80 cents per share. Now remember, they told us that the extra shares do not get this dividend. It's only the 50,000 and 80 cents per share. So now, if we look at the recording of that, our ordinary share dividends, our expense, we record 40,000. That's the 50,000 times the 80 cents, 0.8 when you multiply. And because these dividends were paid, the double entry will be bank, and it comes out of the cash payments journal. Now, if we go further, by the time the end of the year comes and they work out the profit, the directors then decide to declare a final dividend of 100 cents per share. Now, we need to take note that they only declared it. They did not pay it. Very different from the interim, which was said it was declared and paid. The reason why they haven't been paid yet is because the directors can propose this, declare it, but it's got to go to the AGM and the shareholders have to agree. But from a recording point of view, we need to bring in now that there's another dividend of 100 cents per share, but these have only been declared, so they have not been paid. And just for the purpose of the calculation, remember, we've now got all 75,000 shares, and at 100 cents per share, it's another 75,000 Rand. So we are going to debit the dividends account, because it is another dividend for this year, because we need to get the total dividends for this year. But because it's only been declared and has not been paid, our double entry brings in the liability account, our ordinary share dividends. We owe them. Now, in the normal course of events, the AGM will probably approve this, and then these people will be paid, at which stage you'll credit bank, you'll debit your liability, and that settles your account. The dividends, on the other hand, your expense account, records the total dividends for this year. So let's go into the next video and see what happens.